Do stocks always go up over the long term? Well, if you look at this chart of the S&P 500, which represents the stock market overall, you'll see that since 1926, it's gone up. It's gone up by a lot. That doesn't necessarily mean that your portfolio would also go up over time. Let me explain why. Hey, welcome to Stock Sessions. My name is Jeffrey Lin. So just as a disclaimer, this video is only for educational purposes only. It's not any investment advice. If you need investment advice, you got to talk with your financial advisor or your financial planner. And speaking of financial advisors and financial planners, they've probably shown you a chart like this of the S&P 500 or the Dow Jones representing the overall stock market over the past 90 some years. The stock market has gone up over time. The S&P 500 has gone up about 9% since 1926 when it first started. The problem with your portfolio is you're not going to be invested over 90 years like this chart shows. Your investment lifetime is probably going to be 30 or 40 years, and in there's just going to be a main bulk of time when you're making a lot of money at your job, where you're really hitting the peaks of your career and you're able to invest more. You're not able to invest a lot when you're younger, and you're going to be taking out money for retirement when you're older. To show you a chart of the S&P 500 over 90 years and say you're going to make money every year 9% throughout that time is not realistic. So the stock market has periods where it goes up a lot, where it trends, and periods where it's mostly flat, and then periods where it goes up again. If we zoom in on this period where it was flat, you'll see that the peak from the dot-com bubble all the way up until 2013, you didn't make any money. It was flat, and actually your portfolio would have dropped about 45 to 50% twice during those years. You had a period of 13 years in here where your portfolio was just trying to get back to break even. You're just trying not to lose money. And a couple times in here, you had lost money, and if you try to cash out, whether to buy a house or to pay for your kids' college education or to pay for your retirement, you would have lost money. So the question you have to ask yourself is, are you able to sustain not making any money off of your investments for 13 years or longer? And are you able to withstand losing half your portfolio if you have to take some money out to pay for retirement or even to pay for medical bills or to buy a house? And you might think this doesn't happen very often, but if we look back at the S&P chart again, this is from 1966 to 1980. The stock market was also flat right here. You would have to wait 14 years to get your money back. And if you needed your money somewhere down here or somewhere down here, you would have lost a third to almost half of your money. We can look at another chart of the S&P 500. We'll look at the Great Depression from the 1929 crash right here until 1954. So for 25 years, you lost money. All of this part in here lost money. You have to ask yourself if you're able to withstand not having to be able to cash out of your retirement account for 25 years. Are you able to delay your retirement for 25 years? Or do you have to start cashing out in here, maybe in here, maybe in here, maybe in here, but still you're way below where you were in 1929? That's the question you have to talk with your financial advisors about. One of the things as professional investors we always look for is having an exit plan. So you want to sell to take profits when you can. As we looked at before on this chart of the recent S&P, if you're able to sell a little bit in here, or in here, or in here, take some profit, you'll have your retirement funds to use. You wouldn't have lost it all in this period from the dot-com bubble bursting. You would able to retire instead of having to try to wait until this peak in 2008. But if you did, you could have tried to cash out somewhere in here instead of getting hit by the financial crisis. So you could have retired in 2008. But I know a lot of people who missed cashing out here, missed cashing out here, and they had to wait another 5 years until the stock market got to where it was all the way back in 2000. So you have to ask your financial advisor, how do you cash out of your retirement investments when you can, when there's still profits up here, instead of after the stock market already drops and it's down here and you're trying to retire down here and it's already too late. Even though we know you can't always perfectly time the market, if you don't take the profits when you have them, the stock market will take it for you. You're probably thinking to yourself, the stock market will always come back, right? Well, that's not always the case. It has been true for the US market, but it hasn't been true for many markets around the world. So looking at Japan, you'll see that its bubble burst here in 1990. And since then, you haven't made any money. You're still down by almost 50%, even though the market had gone up since 2010. So this is a very long time right here. You waited 30 years. So for people in Japan, even after waiting for 30 years, your portfolio hasn't gone back to where it was in 1990. You can look at another example of the index for Britain, UK stock market. You'll see that from here. You'll see that it hasn't really gone anywhere since this peak here in 2000. It's just been going up and down, up and down. So if you try to retire in here, you would have had to wait for 20 plus years. And right now with the stock market crash of 2020, you're still way below where you were at the peak in 2000. So it's taking a long time, and it's really impossible for people to wait to delay their retirement for 20 years or have to live off of much lower investments. You expect your investments to grow even throughout the time that you've gone into retirement and you're taking a little bit out, but you still want that money to grow. You don't expect it to just sit there for 20 years and not go anywhere. Are individual stocks better if you pick the best companies, the best of the best, like today's Apple or Amazon? Well, if you look at what these are called blue chip companies from the past, General Electric has been in the Dow for a long, long time. And in 2018, General Electric was kicked out of the Dow and replaced by Walgreens. So you can see from this chart that General Electric did amazingly well. If you took profits up in here, you would have had so much more money to retire on. But if you just kept on waiting and waiting, hoping it'll come back, your portfolio would have gone down, came up a little bit, come down, came up a little bit, and now it's all the way back to this level where it was in about 1995. So your portfolio had made a lot of money and it had lost it all again. So again, if you don't take profits for yourself, then then the market will take the profits for you. GE is one of these companies that people thought would always be around. They're still Their engines are still in most of the airplanes that are flying around the world. Their generators power most of the utilities, the power companies around the country and around the world. But this is what happened with your stock. So again, it's really important to when you're managing your portfolio to have an exit plan, both to take profits when you have them, but you also want to sell to protect your capital, to protect your money from limiting losses. Most people think that you can just hold it and the stocks will come back, but preserving capital will save you so much time and allow your investments to keep growing instead of having to wait the 20 years, the 30 years that we talked about, where you have to wait for your investment to come back. And to put that into perspective, what is your break even if you lose some money? So if you lose 10% down, that means your stock has to go up 11%. If your stock is down 20%, then your portfolio has to go up 25%. Both of these are still doable. It's not ideal, but it's doable. But what if we lose 50%? You're going to have to make up 100% or double your money. Now, if your stock or portfolio drops 90%, then you're going to have to make 900% in profits. And that's something really, really hard to do. It's really hard to make 25% on a stock, and it's even harder to make that in a mutual fund or a portfolio. To make 900%, that's 9 times your initial investment, just to make your money back, just to get to break even so that you don't lose money. That is something very, very hard to do. If you're able to just sell a little bit early and protect that money, you'll be able to make it back a lot faster and get your portfolio to keep growing instead of having to wait 20 or 30 years just to get your money back. All right, thanks for watching. On the Stock System channel, we're making the stock market simple so that you can understand it and so that you can manage your own portfolio and your own investments and analyze stocks on your own. If you found this video helpful, please hit the subscribe button and leave a comment below. We want to know what else you want to see from us. And please, please, please share with friends and family that will need this information, because your retirement and your future is all in your hands. So it's really important for you to learn how to manage your own investments and understand how investments work.